Hello everyone. Today we will talk about one of the important topic in fund accounting, which is rights. We know in fund accounting we come up with different corporate action. So today one of the important corporate action which we will be discussing is rights. So before we start, we need to understand what is rights. Before that, we need to understand what are the different kinds of corporate action we see generally. So generally, we see two kinds of corporate action. One is voluntary corporate action and one is mandatory corporate action. So when we have a voluntary corporate action, in that case, the shareholder have an option to execute the corporate action or they may not execute it. However, when we have a mandatory corporate action, the shareholder is bound to go ahead with that corporate action. The today's topic, which is rights, comes under voluntary corporate action. So now I will tell you what is rights. So right is an option for the existing shareholder to purchase additional new shares of that particular company in the lower than market price. So let's go ahead with this with one of the example. So let's assume that there is a company ABC which is having a market price of 50 rupees. Now, the company ABC is currently going for a rights which is having a issue price of rupees 39. So now the company is going ahead with the below rights issue. So the rights issue will be rights ratio is 5:1 and the share ratio, rights to share ratio is 1:1. I will explain this in details once we go ahead with this example more. So let me give you one example of a person. Let's say there is a person Z who is holding ABC company share, 50 of them. So now this person who is person X can go ahead as per the right share what we discussed earlier, which is this 5:1. So for that the person Z is eligible for 10 rights, because as we have given the example before, we have 5:1 rights ratio. Now, when I told about 1:1 share ratio, in that case, for this existing 10 rights, the person Z is eligible for 10 shares, which is going to be 1:1, which is the share ratio. So now, if we go ahead with this example, and now if we see what is the person Z have the options to do. So he have an option to buy these shares at rupees 39. So if I give you the normal example, if the person Z want to go into the market and buy these 10 shares, the market price is 50 rupees. So if I give you a cross example, for 50 into 10 share, he have to approximately spend 500 rupees to purchase this. But when he is buying from this rights with the issue price, it will be just 390 rupees. So that is where the person is making the profit. So this is the difference of these two amount is going to be the profit for the person. So now how this is going to happen and what are the important things in the rights that we are going to discuss. So if we see now, when we go with the rights, there are three important topic or three important point we need to understand. First point is issue price. In our example, company ABC is issuing it at 39 rupees. Next is the period, which will be your trading period. That I will give you more into this example. And third and very important, and I will give more emphasis on this because this is many time interview question as well, the intrinsic price. So first is the issue price, which is very important when it comes to a rights. So there will be always a issue price which is lower than the market price for the particular company. Next is the period. So generally what happens, there will be a period in which you can hold the right and then you can go ahead execute it, or it is voluntary, you can lapse it. So let's say I have a trading period of 10th June to 25th June. So I have an option to execute or to go ahead and trade the right for this time period. Now, why this trading period thing is coming? Because rights, generally, we will have two kind of rights. One will be a tradable rights. And another one will be a non-tradable rights. So what is a tradable rights? When you have a tradable rights, that means whatever rights you are getting from the company, you have an option to trade them into the market. So as we said in the example before, if you see this example, the person Z had a 50 shares. So from the 50 shares, for 5:1 ratio, that the person is getting 10 rights. So this person Z, if this particular right is a tradable right, gets an option to go ahead into the market and trade these 10 shares. So either he can sell those rights or he has an option of buy those rights. But in case it is a non-tradable rights, for that point you don't have an option to trade it. But for this particular period which I mentioned, which is 10th June to 25th June in this example, you have an option to hold this, and after that you can decide what to do about it. Now third point comes into picture, which we have, which is the intrinsic price. What is intrinsic price? Why it is so important? So when I am talking about rights, if you think from a fund perspective, in that fund, that investor is getting those extra rights into the fund. So how these rights will be priced? It is very important to understand how this rights is getting priced. This price is called the intrinsic price. How it is priced? That is a very simple example. Rights price, the intrinsic price will be the market price of the particular company minus the issue price. So this is a typical example, or this is the typical formula for the intrinsic price. So if I see my example here, let's say on day 1, my market price is 50 rupees. My issue price is 39. So in this case, my intrinsic price will be 11. On day 2, let's say my price has dropped to 48 rupees. Now it is very important, one more thing to understand, and it is a thumb rule, that whenever there is any corporate action, we have to always understand there is always a way to balance out the price. So in case there is a corporate action and you're issuing something, let's say here you're issuing some more, you're going to issue some more new shares. So if your price remains same, your market value in the market is going to increase. So that will never happen. Whenever there is a corporate action, your price is increasing from one point, there will be another way of the price to drop, so that the net value will be balanced. I will take more videos. I will come up with more videos to explain and give you more example on this, how this price is going to balance. But let's look at it today. So your price has gone down to from 50 to 48, and your issue price is remain same, which is 39. So in that case, your price will become 9. On day 3, let's give one more example. your price has gone down to 45 and your issue price is 39. So your now current price will be 6. There can be an example, let's say I'm going below of more days and let's say you have a day 4 or day 6, let's say. Your price has gone down below 39. Let's say your price has moved to 35. But your current market price, your issue price is still 39. So in that case, your intrinsic price cannot be negative. So in that case, your intrinsic price will be 0. Your intrinsic price of that rights line which you have in this particular case for person Z, you have 10 rights. Your 10 rights will be priced at 0 unless and until your ABC market price move above the issue price, which is 39. So this is how generally you will be pricing the rights line. Now, when you have a tradable rights, in that case, other than this particular calculation, you will have external factors which is going to impact your price, but that will not move drastically. Even for the tradable rights also, you will see the prices will go almost near about this calculation and this formula which I now explained. So these are the main factor. So now we need to see for a person Z, what are the options he have. He gets the issue price, he has the trading period, he gets the intrinsic price. Now what is going to happen? So for the person Z, he gets 3 options. Option 1, the person can go ahead and trade this right. He can go ahead, go for the buy and sell in the market. And once this 15th June time is over, after that he can get the 10 shares. So as I have told in the previous example, if we see here, he is getting 1:1 share, which is the 10 share. So once the trading period is over, he can go ahead and he can get those 10 shares. He trades and he can get more shares. Option 2, that he is selling all the shares and he will be selling all the rights and he will be not left with any shares. So whatever benefit he is going to get. So if I see this example, here he has 9 rupees. He got 10 rights. So 10 into 9 is the 90 rupees. What will be his benefit? So that is one more point. And third option for the person Z is going to be that he don't do anything. He will not execute the rights. So the rights will remain in his fund for till 25th of June or whatever will be the trading period. And after that, that rights will get lapsed. So these are the 3 options what a shareholder of the company who is issuing the rights get those options to do. And that is what the options you get when you are having a voluntary corporate action. So how to know what are the ratios they are giving or what is the issue price of the particular, like this I said, the issue price of the particular company. There are always external sources. So you have any company, for that company you can check on the IDC, you can check on Bloomberg, and you can get to know in details how you will be getting to know all the information about a particular corporate action. And lastly, if this question might arise, why a company will go for the rights issues. So generally a company goes for or take this option of going for the rights issues to increase their market value or increase their capital. Generally they use this capital to do some of the research, or sometimes they want to increase or open new companies. For those reasons they will be going for the rights. So this is all about today's video. Please do let me know in the comments if you have many questions for this. I will come up and I will answer all those, and I can make more videos accordingly. Thank you very much.